Tuesday the 31st of January. So let's just have a quick recap of some of the price movement from yesterday. Certainly one of the more interesting sessions that we've seen thus far for 2017, or certainly one of the most volatile days. And then we'll take a look at what we're looking for today specifically for the rest of the session. So firstly then, looking at equities, obviously extremely volatile day yesterday. Starting off with, well, really the DAX, which gapped lower. You kind of had that interpretation of the Trump, the executive order on the immigration issue on those several countries that had a massive backlash politically and protests across the nation and globally from and also condemned by foreign governments as well as large corporations. Particularly, I was reading this morning, a lot of the tech firms, say Apple, Google, and so on, obviously based in the US on the West Coast, who employ a large amount of kind of foreign brain power, if you like, recruiting from places such as India and things like that. And although they weren't specifically mentioned in those countries, obviously this kind of more aggressive tactics on foreign policies and foreign workers in these industries certainly is something which those corporations are getting quite nervous about. But you had the gap lower yesterday. We moved lower again at the cash open, and this coincided with those inflation readings that I was talking about this time yesterday. We had those German state regional CPIs come in a little firmer on a year-on-year basis. That hit bonds as well as equities on the kind of thinking that actually maybe the punch bowl that is QE that's been propping up the equity market for so long, maybe, or the ECB may be forced to remove that. And as such, that was a net negative. And actually, one of the interesting things what was occurring yesterday was that even though you would say a removal of QE then should be a net, probably a positive for the euro, actually those correlations did break down, and the euro was under pressure, as was European equities and the Bund. A trifecta of selling, if you like, on those European assets. And I think the FX move more was a byproduct of just that dollar recovery that we were seeing throughout the morning yesterday. But then this kind of biggest candle to the downside on the DAX coincided, of course, when Wall Street opened. That was when we saw the volume of selling pick up substantially. Just looking at, this is the S&P here, and really very quiet during the morning, quite a tight confined range, and then a real breakout to the downside. And if we look at this slightly longer dated, this is what I was looking at yesterday. So really you need to put this into a bit of context, and just highlighting here with the circle that this was the ramp up that we had of those factors, multiple of Trump kind of delivering in his first week in office, really front loaded in the first half of the week, the pipeline deal and so on, then technically breaking out of the top end of the range that had been defining the price action since the beginning of 2017. That caused another move to the upside, every time here printing record all-time highs against all three indices. So a degree of profit taking into the latter part of last week, the gap down on the Trump news on immigration at the weekend, then the open and push lower to basically put us right back to where we were about a week ago. Now, the way that the market was moving yesterday, obviously it did look extremely aggressive, but and let me just show you the headlines that are being run in the FT. US stocks suffer the biggest decline of 2017, biggest jump up in the VIX in a number of months. Yes, that is true, but if you look at how tight the range has been in the S&P, we actually only were moving really around maximum of percent, which isn't that big a move really in the context of historical moves, but certainly in the context of how tight the price action has been. There's been a couple of exceptions on the intraday really towards the end of the year, but generally speaking through 2017 it has been a fairly narrow market in terms of its range. So net we're back to really where we were around the beginning last Monday, and that puts us then upside we're looking at the top end of that range, really, which we broke there initially Tuesday last week. So that 74.25 level might be looked at in interest if we continue to move back to pair some of those losses. Just having a look then, a couple of things. The VIX, I just mentioned it, actually on the stat, it rose by the most since November 3rd. Equity markets had their worst day of the year. The S&P down 0.6, closed down for the third day in a row whilst having its worst day. The Dow also psychologically back below 20,000. Obviously that was the big figure which also catapulted equities higher last week when it broke that big barrier for the first time. So that might also be psychologically significant as well for the market. One thing I saw was quite funny in the FT. Apparently traders have attributed some of the activity to one investor that's being nicknamed on Wall Street 50 Cent, because they purchase protection on the VIX Volatility Index each morning at a price of 50 cents. So given all the political uncertainty, it's odd. Some investors have been quoted as saying in the FT this morning for the VIX to be so low. So essentially, people like 50 Cent are loading up on equity crash protection while it's cheap. And so buying it, picking it up at 50 cents each morning. So definitely that has been a surprising area, I guess, even with the ramp up in what we saw in the VIX yesterday. It is still very close proximity to really record low territory, but you would think that surely that has to change, and that kind of leads us into a chart I wanted to share with you, which is gold. And actually gold is heading for its biggest monthly gain since June, given this latest bout of Trump uncertainty. Just looking at the monthly performances, you can see here how gold has performed, and really it's the first the last time we had an up month like this, you can see all the way back to really when Brexit occurred from last summer, when we've had such a solid up month. Obviously this was probably the biggest surprise of the last quarter of 2016, was when a lot of people were thinking if Trump were to win, which of course was an outside bet, that would cause massive uncertainty in the market, and you'd have a flight to quality bid, where the complete opposite happened. That was when you had people, after a knee-jerk reaction higher in gold. The bigger play, obviously, over the coming weeks after the election was a persistent sell-off in gold as people bought into this Trumpflation idea and Trump trade. So that was actually one of the biggest falls we've had in a long time. But then actually now starting to recover, and if you think about it, from let's say Q1 or first half of 2017, possibly from a volatility perspective, the best is yet to come. That being heightened inflation in the Eurozone. How's that going to play out with the ECB and potentially tweaking their QE going forward? You've got elections coming up in various European nations, and you've got Article 50 and the Brexit process, just to name a few things. So certainly a lot on the agenda to look out for. One of the other things to have a look at from this morning is inflation in Europe. I think it's best if we start with the German number, and just looking at the performance here kind of this morning and of yesterday, and the two real areas of interest here are when the CPI numbers are coming out, and inflation is becoming an ever more closely followed factor for really global central banks at the moment, but certainly from the ECB. This is what I'm looking at here. So yesterday morning you had the German inflation numbers come out. These are the regional ones. And the Saxony one, which was the first, and if you remember, much like with other economic data, although there's several German regions that report, the first one normally carries the most clout because it's the first time you get to see the first reading, if you like, to set the tone for the other regions, and then ultimately what the pan-German number will come out as. And the Saxony one surprised sharply to the upside. I think the year-on-year was 2.3%. The actual national number came in at 1.9, which was only slightly above previous and was actually 0.1 below expectations, because at 2%, I don't think we've been at that 2% marker for nearly 5 years if we got that high. But certainly you can see there's been a big ramp up recently, particularly for the Germans on the inflation side. So price pressures are certainly becoming elevated. And if you look at this morning, we've just had the Spanish number. Inflation is now at 3% in Spain. That's the highest since December of 2012. These are definitely areas where, when you're listening out for ECB speakers, we've had Draghi talking this morning, but totally nothing relevant for the market, talking about, I think, digital integration. But definitely, if you ever see an ECB member scheduled on the docket, you should be paying extreme attention to anything around the words of inflation. You know, an ECB policymaker is not going to probably comment directly on the QE program in terms of tapering, but they'll hint towards that by how they view inflation playing out in the future. That will be the hint then towards how they'll tweak the QE program, which is critical for trading European assets. So that inflation story, I think, has definitely occurred yesterday, and it's still at play. If you look at the Bund this morning, took another hit around when that Spanish number came out, and with, I guess, a slight uptick we've been seeing in European equities, the cash open, the futures, and the DAX also just edging back up here. Pivot seen about 15 points above current price at 11,703 at the moment. A few other things just to have a look at. With yesterday's volatility, obviously the whole Trump was first and foremost kind of dominating the news, but there were a couple of other things on the sidelines that certainly are not to be discounted. You've got Greece at the moment. Along with the sell-off in bonds, the Athens Stock Exchange suffered its second consecutive 3.5% fall, as the government and European creditors failed to make any progress on the terms and conditions attached to the Greece's latest bailout review. So you've got Greece also struggling. Italy, the fallout from last week's constitutional court decision continues. A trade update from UniCredit. Now, UniCredit said yesterday, again, didn't capture many headlines, but they said their capital ratios will not meet ECB's requirements. So still a lot of nervousness about the Italian financials and their banking system. And then in France, there was also a bit of a catalyst to yesterday's moves, with market jitters on the rise following the victory of Hamon in the socialist primary. And the victory appears to have sparked further momentum and interest of independent challenger Macron. So a bit of changing of sentiment as well, where politically they're leaning in France. So again, there's quite a few things here all going off at once, which I think kind of really initiated the first real spark into market activity that we've seen this year in 2017. But certainly reading up in what a lot of market pundits are saying is that they do think that this will definitely be the sort of theme that will become prevalent over the coming weeks and months. And definitely for you guys, it does provide obviously some good opportunity in terms of more decent market movement rather than the confined ranges we were seeing towards the kind of latter part and early part of this year. Some other things to be aware of. We have had the Bank of Japan overnight, but really a non-event, so to speak. They kept policy steady. They maintained their upbeat price forecasts. But there are a couple things that you need to be on the lookout for in today's session. If I just flick over to the calendar, you can see this morning you had German retail sales numbers. Now, they came in actually pretty weak, but German retail sales numbers, I would say, are very low down the pecking order of what really the market jumps on in terms of impact of prices. But the German retail sales for December were minus 0.9% month-on-month. Expectations were for plus 0.6%. The year-on-year was also substantially weaker than expected. But looking further forward, you do have German unemployment change and unemployment rate. Now, actually, the employment situation in Germany is in a bit of a sweet spot at the moment. It's been performing very well. Much like in the UK, unemployment is at exceptionally low levels at the moment, and this is what the unemployment change looks like. And remember, negative number means a more positive situation, and you've had 17 straight months of falls in unemployment in Germany. And actually, the last reading was the biggest decline since January, and was much better than expected. That was minus 17,000. So I would say the stage is kind of set. The employment situation in Germany is robust. I would not really be anticipating this data to have too much of a read across to the market this morning. That's unless it flips and turns massively up, i.e. the number of unemployed increases, which is actually would be a break from these historical patterns that we've been seeing. That would be something of note. Going back though to the calendar, some other things to be aware of. You've got the CPI from Eurozone, but this is the Jan final figure. In the afternoon, you've got Chicago PMI, which is really your US data highlight. Now, quick look at Chicago PMI. Remember, in advance, this is the one that gets delivered via to subscribers ahead of time. So this tends to see some market movement about 2.5 to 3 minutes before the embargoed release time. I'll cover that again nearer the time, but be careful with that because it's normally a buy the rumor, sell the fact price action that you'll see a couple of minutes before the actual release itself. But that's also, in terms of where it stands at the moment, you can see here a fairly robust number over the last 2 months, albeit the last reading was a slight deterioration from what we had in November. But probably, again, nothing too much to really change up the Fed direction, and obviously this comes ahead of the Fed interest rate meeting, which is underway, actually commencing today, but we'll get the decision from tomorrow. Remember, this week's Fed, though, it's just a statement. There's no press conference or anything like that from projections or conversations with Yellen. The other thing also just to talk about today from a sterling point of view, if you're trading cable, is that today is the commencement of the 2-day debate in the House of Commons on the government's draft law to give PM Theresa May authority to trigger Article 50. Now this could be interesting just because Theresa May came under a bit of a, I guess, domestic MP bashing over the weekend on how she responded to questioning about whether or not she agreed with Donald Trump's stance on that visa ban, of which she really declined to comment for at least 24 hours, and that came under scrutiny from a variety of different MPs, even those within the Conservative Party. So be interested to see how those conversations play out today. And one interesting point here, I was just reading in the Telegraph this morning, is that once this gets underway, is that Conservative ministers and MPs have ordered, or have been ordered, to stay in the House of Commons until midnight tonight, amid fears of an ambush vote by pro-Remain MPs during the Article 50 debate. What this basically means is that the government has ordered a running whip tomorrow into Wednesday for a 2-day debate. Just to give you what this actually means is, so back in the 70s, when there was a very slight, you're talking about 2-3 seat majority for the ruling Labour Party at the time, what it meant was that actually you would need all of the MPs whenever there was a vote to walk through the lobby in order that you could get all of your vote counts in. I.e., if someone was ill, what they would do, there would be a gentleman's agreement to say that, okay, we're the Labour Party, someone's ill, the chief whip would speak to the opposing party and say, you need to remove one of your guys. And so that it's always an equal amount, vote for vote. Now, if you remember what happened back in the 70s, basically it became it was such a narrow margin between the parties. It was a complete complication, kind of almost a hung parliament situation, which meant that it got to a point where there was a standoff and the gentleman's agreement broke down. And essentially what that meant then was that if someone was ill, then your party would be down one vote. So what the Labour Party were doing were basically getting people who should have been in hospital, people who were on their deathbed, they'd be wheeling them into Parliament to vote on these MPs. And well, eventually that was very, very messy indeed, when actually politicians started dying, which was actually a true fact during that period. But what I'm saying then, what this means is that in true sense for today, is that basically if you're a Remainer, now they're not going to look to stop Brexit happening, but what they could do in order to make Theresa May have, let's say, egg on her face, is they could delay the ability for this to go through in this 2-day hearing in order that she does not meet her end of March deadline. That would be quite a big signal, big blow for the government. Politically, you'd be able to get one over the kind of May's camp, if you like. So what the May's team are having to do then is to make sure that all MPs at any moment are ready to walk through the lobby for a vote. And that can be up until midnight, because if they were to go home, essentially the opposing MPs could all come together, form an alliance and call a vote, immediately walk through the lobby and actually get this a vote put out. Could almost hoodwink the government, if you like. So essentially all the MPs have got to sit there until midnight, and I've read a couple of sources saying that they've bought in the booze and they're going to have a bit of a party tonight, which I'm sure that won't go particularly down well with the voting public, with a bunch of elitist politicians getting drunk in the Houses of Parliament. But some things never change, I guess. But yep, definitely an interesting thing to keep an eye on. I guess if you're trading sterling, these hearings will be going on. I guess there'll be live parliamentary feeds as normal, and that could add a little bit of volatility, I guess, depending on how the conversations are going. Overall, broadly expect this to go through without really any too much issue, but just in the context that Theresa May has been politically under a bit of pressure more recently, should keep things quite interesting in the sterling currency. So I would keep half an ear out on this as it develops throughout the day. The actual ruling, though, itself probably won't come until tomorrow evening, I would imagine. Just so you're aware, just had the German data come out. So the unemployment change was minus 26,000. The unemployment rate drops to 5.9%. So let me just see if this is updated. That's a phenomenally strong number. Let's just have a quick look. Well, you're probably looking at like 2014 levels, I guess, with that German number. But the thing, just before we wrap up here, I've just seen in the fast FT, euro and government bond yields climb after early inflation surprise. You can see that when I'm trying to gauge market, let's say, sentiment and what are the macro drivers of prices at any given point in time, this is kind of, when you get this sense over what people are talking about on Twitter, what the press are kind of latching onto, and what you're starting to hear more and more about is definitely this angle about inflation. So the Spanish number higher since 2012 this morning, French inflation more than a 4-year high, and you had the German inflation also up this morning. So maybe the Bund is the trade at the moment in terms of where it's priced. Let me just have a quick look. Obviously the Bund has been, well, as an asset, there's many times we were asking about how far can it keep going to the upside, but certainly this could be a trade of the first half of this, I'd say, as a longer term strategy, the first half of this year to look at potentially. Okay guys, gonna leave it at that. Coming up to 9 o'clock, I'll be in the chat as per normal, so any questions, feel free to pop them in there. Be happy to help. Okay, have a good day.